Well, hello again. It's Barry Ruby, and I'm ready to get going with, and hope you are too. We're looking at this video number 3, which is the third part of an introduction to commercial real estate. So far, what we've covered is in video 1, how to use this pro forma. Video 2, we covered the net operating income of a property and its capitalization rate and therefore its value. And in this video, what we're going to do is cover capital stack, net cash flow, debt service coverage ratio, and a little bit up here about the cheat sheet, what that story is all about. And stay tuned for video 4, where what we're going to do is underwrite using this pro forma, underwrite the acquisition of a cash flowing property that is actually for sale somewhere here on the internet. So let's get into the meat of video 3 right now, which is to look at something called capital stack. Capital stack is just another way of saying, where are you going to get the money to pay for this $14 million multifamily project that, or whatever the income stream is. I really shouldn't say it's necessarily a multifamily project. So if we are generating a loan against this purchase price, there is a pull-down menu here that runs from 0%, which can then let you look at what the world would be like if you didn't put any debt on it, which interestingly you see here. We talked about in video number 2 how the acquisition cap rate was the cash flow, the cash on cash return unlevered for the project. And the project cost $14.3 million. And if there's no debt on it, there is sort of a reverse check on the fact that one equals the other, an unlevered cash flow. So since what we're doing is looking at putting a loan on the property, and typically if you use 75% as a loan to cost, not value, then that relationship would create a loan of just a little under $11 million and an equity requirement of $3.5 million. And if you remember, this is a variance that we have up here. If we said, what happened if we varied the cap rate 1 point? What goes on down the line with capital stack and cash flow and debt service coverage ratio? Well, what's happening is we're raising the cap rate, which means we're lowering the sales price, which means that in this case it's $2 million and then $3.5 million. But you can also see that what's happening is what we're doing is also decreasing the loan, because we're decreasing the purchase price. And we are also decreasing the debt service that goes against that. And we are also increasing the debt service coverage ratio. All of that by just a 1 point swing in cap rate. Half a point, you see the impact there as well. $1 million basically of value drops the value or the purchase price of the property by $1 million by just a variance of 0.5% of cap rate. So let's just go back here and set this. There is no variance, and we'll just follow through on now that we have a loan and we know what the equity is. We come back to the ever popular net operating income, which we developed up here in the first set of data points. And the debt service for this almost $11 million loan is calculated by a payment that, if you look up here in the formula bar, don't freak out. All this is saying that if you borrowed this amount of money at this annual rate of interest and amortized it over this many years, meaning that's the term of the loan, then your payment would be $665,000 against the roughly $860,000 of net operating income, which leaves net cash flow of just a little over, no, almost $194,000 a year. So that net cash flow, if you're trying to determine the cash-on-cash return that the project would demonstrate under these circumstances, again, if you look up in the formula bar, the way that cash-on-cash return is calculated is dividing the net cash flow by the equity. And here's the net cash flow, and here is the equity, and here is the result. So the other really important element to be aware of when you're projecting the amount of a loan and the kind of payment that you can generate against that loan is something that has to do with the fifth and last element of this pro forma, which is something called the debt service coverage ratio. Debt service coverage ratio is nothing more than saying how many dollars of income does the project have to support the debt service that is required to be able to fund and keep the loan that you made in good standing. Another way of looking at that is to say that if we looked at this and we said, well, I've got $859,000 divided by, and I'm going to keep this number positive here, by the debt service, by making it a minus number, that's where the 129 comes from. In other words, another way of looking at debt service coverage ratio is the bank saying, or whoever the lender is, or whatever the lender is, how many dollars, how safe is my loan? How many dollars do you have coming in the form of income to be able to cover the principal and the interest debt service on the loan that I made to you? To look at this another way, let's say that what you were looking for is an 80% loan to value. The debt service coverage ratio just dropped from almost 1.3, go back again, from 1.3 to 1.2. So what lenders in general are looking for is as high of a debt service coverage ratio, which means there's more than enough money to make them feel comfortable that they're going to get their payments. Typically, a project, let's say this is a multifamily project, 1.2 is about, it's on the low end of debt service coverage ratio, because basically what it is you're telling the lender that you have $1.20 of income to cover every dollar of debt service that's made. So if you want underwriting this project conservatively, so that there's some room in there for you to maneuver, 75% loan to cost is a reasonable number to assume for initial modeling. The other thing that also affects debt service coverage ratio and payments and all the rest of it, as you can imagine, is let's say instead of 5%, we could borrow at 4.5%. Well, the rate of return goes to 6.4 from 5.4, and the debt service coverage ratio goes to 1.36 from 1.29. The other variable that has to do with debt service coverage ratios and payments is the term of the loan. The shorter the period of time that you have, the more principal that you have to retire because of that shorter term. And with it, the higher your loan payment is, so the lower your debt service coverage ratio is. Because if you remember, way back when we originally talked about net operating income, this is the sort of the gold standard. It is the major metric that enters into underwriting, return, safety, danger, risks, perceived risk, and so forth. So the only other thing that I want to make you aware of is here that sometimes if you're going to do a rehab, that you can get an interest-only loan for some period of time. And if you want to calculate interest-only loan, what the pro forma allows you to do is select 0 here and put in whatever the interest rate that you believe you're going to be able to get, so that during the renovation period, which you're going to be spending more money and you're also going to have units offline, what's happening is you have a $322,000 interest-only payment versus a $665,000 interest payment, which is really going to help the cause, right? But for now, let's leave this as a fully amortizing loan at 5% that creates a little over a 5% cash-on-cash return in year 1, and a debt service coverage ratio that is heading towards a sweet spot, which is 1.3 or anything over that. So before we leave this video number 3, I want to come up here and revisit the nomenclature and the metrics that go on with analyzing any commercial real estate asset. So up here in the upper right chart, you can see that there's a thing called an acquisition cap rate. We talked about that. And if you slide your cursor over to any of the numbers that, any of the factors that are in this green box, it's not only reporting what the performance of the project is, sort of like I said, it's kind of a quick cheat sheet, let you be able to do that. It also, if you look up here in the formula bar, tells you how each of these figures reminds you of how each of these figures are calculated. So acquisition cap rate is net operating income divided by purchase price. Debt service coverage ratio is net operating income divided by debt service. Cash on cash return is the net cash flow divided by the equity, and so forth. Might as well finish it up. Gross rent multiplier is purchase price divided by gross potential income. And last but not least is a metric that I've never found much use for, but it's out there in the financial and modeling world. And it's called the 1% rule, which is basically says if you take the gross potential income and divide it by 12 and then divide that by the purchase price, you have that 1% rule. Well, here the project is like pretty close. You know, it's almost 1%, it's 91%. So there you have it. Again, if you do not have a copy of this pro forma and the 4 videos that back it up, come visit us at groundupdevelopment.com. You can download a copy of this workbook along with the videos, and hope you do. Thank you very much for listening and watching, and please contact me if I can be of any help.